Welcome to the Deep Dive. Today, we're going to upgrade your ability to read the financial news. We're moving beyond just the raw dollar figures you see on a balance sheet.
Exactly. We're trying to extract the actual financial story of a company.
Right. So if you've ever looked at, a company's filings and felt like you understood all the ingredients but not the recipe, this is for you. We're going to give you the blueprint.
That's absolutely the goal. Our mission here is to give you that essential diagnostic toolkit. We're talking key financial ratios, common size analysis. We aren't just summarizing the numbers.
No.
We are here to interpret them, to figure out a company's fundamental health, its efficiency, and its underlying risk. We want to turn you from someone who just reads the data into an analyst who knows exactly what tough questions to ask.
Okay, let's unpack this then. Let's jump straight into the foundational concepts. The six essential financial ratios. These are the tools, right?
These are the tools. And we can group them into categories to, get a comprehensive look at a business. We start with liquidity, which is all about short-term survival.
Okay.
Then we have leverage, which is a measure of financial risk. After that, we get into operations profitability and efficiency. And finally, the big picture, overall performance and market expectations.
Let's spend some real time on those first three core areas. They feel like the absolute building blocks for understanding financial stability. So let's start with liquidity. What's the fundamental question here?
With liquidity, you're asking, can the company pay its short-term bills, the ones coming due in the next year?
The main tool for that is the current ratio. It's simply current assets divided by current liabilities.
The simplest measure of safety.
It really is.
And we have a good example from our sources, Blaine's hypothetical company. They report a current ratio of 3.60. So that's what, $3.60 in ready assets for every dollar of short-term debt.
Now, the historical rule of thumb was always 2.0, right? This idea that you wanted twice the assets as liabilities to give you this huge safety net. But that's changed.
It's changed dramatically. What's so fascinating is that with better technology, hyper-efficient supply chains, just-in-time inventory, modern companies can run so much leaner.
So 2.0 is overkill now.
In many industries, yes. Today, a ratio of 1.0 or, slightly above is often perfectly adequate. In fact, if a company has a ratio of 4.0 or 5.0, you might even start to ask questions. Are they being too conservative? Are they just hoarding cash instead of investing it?
So right away, we're moving from just calculating to actually interpreting. Okay, so from safety, let's move to risk. Let's talk leverage. How much of the company is built on debt?
That's where the debt ratio comes in. Total liabilities divided by total assets. It tells you what percentage of the company's assets are financed by debt versus the owner's own money.
And for big U.S. firms, somewhere around 50 to 60% is pretty typical.
It's a common range, but it's a huge indicator of risk. A company with a 75% debt ratio is, it's playing a very different game than one at 30%. The higher that number, the more volatile its earnings are going to be.
Especially if interest rates go up.
Precisely. Now, from risk, we move to reward. And that brings us to the fundamental measure of success. Overall performance, which is best measured by return on equity or ROE.
ROE. This is the one the owners, the shareholders really care about. What's the equation and what does it actually tell us?
It's net income divided by stockholders' equity. It measures the return generated directly on the owner's capital investment. It is the ultimate scoreboard for management effectiveness.
How well are they turning our money into profit?
Exactly.
And in our materials, Isaac's example shows an ROE of 20%. The sources say anything consistently over 20% is considered world-class. That's just, a really strong competitive advantage.
The powerful competitive advantage or just incredible operational effectiveness. Something is going very, very right in that company.
Okay, so to round out our toolkit, we should probably define those other three categories, the ones that answer more of the operational questions.
Right. So we have profitability, which is best seen through return on sales, or ROS. That's net income divided by sales. It answers a simple question. For every dollar of stuff you sell, how much profit do you actually keep?
And efficiency, what's the key metric there?
That would be asset turnover. It's sales divided by total assets. It tells you how well the company uses its factories, its equipment, all its assets to generate sales. A high number means you're really squeezing a lot of revenue out of your investments.
And finally, the one for investors looking ahead, market expectations. We're talking PE ratios.
Yes, the price to earnings ratio. Market price per share divided by earnings per share. It basically tells us how much the market is willing to pay today for a company's current profits.
Which reflects what they think about future growth.
A high PE means the market expects big things. A low PE Well, it could mean the stock is a bargain, or it could mean the market thinks the company is going nowhere.
Now, what's so critical to understand is that the right ratio totally depends on who's asking the question.
Absolutely. If you're a banker lending the company money, you are obsessed with the debt ratio and the current ratio. You care about risk. Can they pay me back?
But if you're me saving for retirement, I'm looking at ROE and PE. I want return and I want growth.
And if you're the CEO, you're looking at ROS and asset turnover. You're trying to figure out how to run the business better next quarter. Different ratios for different questions.
Which brings us to a really crucial point. A ratio by itself, just a raw number, is pretty much meaningless.
It is. It's meaningless in a vacuum. You have to have benchmarks. There are three essential comparisons you have to make. First is trend analysis.
How does the number look compared to the company's own history,
Yeah.
the last 5 years, say?
Exactly. Is it getting better or worse? Second, cross-sectional analysis. How does it compare to its direct competitors right now? And third, you need to look at industry averages.
And this is where context can just completely change the story, especially with something like return on sales, that ROS number we talked about.
Oh, it's a dramatic example.
Yeah, if I tell you a company has a 27% ROS, that sounds incredible. And it is if you're, say, Apple, keeping 27 cents of profit on every dollar of iPhone sales.
But then you take that 27% and compare it to, a supermarket chain where the margin might be 1 or 2%. The comparison is completely useless.
Because their whole business model is different. They rely on massive volume, super fast turnover to make money on those tiny margins.
Exactly. So when we look at a company like DuPont with its 8.0% ROS, judging it against Apple's 27% is just, it's noise. The only comparison that matters is to its rival in the chemicals industry, like a Dow Chemical. That's what tells you the real story.
Okay, so with the ratios and the need for context established, let's talk about the tool that helps us see what's actually changing inside a company, especially when they're too big to compare dollar for dollar. Common size analysis.
Common size statements are, they're a great way to normalize data. You convert every single line item into a percentage of a base figure. For the balance sheet, it's total assets. For the income statement, it's total sales.
And that gets rid of the scale distortion. It lets you compare a giant like Walmart to a much smaller retailer on an apples-to-apples basis.
Precisely. And for the balance sheet, you can actually run this analysis in two different ways, and they give you two completely different insights.
Okay, let's start with the first method, what our sources call the efficiency lens. For this one, you divide every line item on the balance sheet by sales.
And this tells you, how much investment do I have tied up to generate $100 of sales? If a company is getting more efficient, you want to see that percentage going down over time.
And we saw this with DuPont's accounts receivable. It went from 17.5% of sales down to 15.4%. That means they were collecting their cash faster.
That's a great operational win. Fewer resources are stuck waiting for customers to pay up.
But this lens can it can flag huge problems. Like with DuPont's other current assets, they just shot up from 3.6% of sales to 11.4% in 1 year.
That's a massive jump relative to sales, and that's where your analysis has to start.
Right. The ratio doesn't give you the answer, but it tells you exactly where to look. Is that a pile of cash for an acquisition? Is it unsold inventory piling up? You have to dig in.
Now, the second method for the balance sheet gives you the structure lens. Here, you divide everything by total assets.
Okay, so the structure lens tells us, how is the company actually built? What's the asset mix look like?
Exactly. What percentage is in cash? What percentage is in long-term things like factories and equipment? It's critical for comparing competitors.
Like the Walmart versus Target example.
Right. Walmart often shows a higher percentage in intangibles and other assets.
Huh.
That's a structural clue that its strategy relies more on growing by buying other companies. Target, on the other hand, might focus more on its physical stores, on real estate.
Okay, so let's apply this to an income statement. Let's look at DuPont's trend between 2011 and 2012. The common size statement tells a story of some serious operational pressure.
It really does. So in both years, sales is your 100% baseline. But look at the gross profit margin. It gets squeezed just a little, from 27.7% down to 27.5%.
So their raw material costs, their input costs, were creeping up faster than their prices.
Creeping up just enough to notice, then their operating efficiency gets worse. It drops from 12.4% down to 11.5%. So they were spending more on overhead, on R&D, just to run the business relative to their sales.
And the bottom line, the net income percentage, it dropped from 10.2% all the way down to 8.0%.
A very significant drop. And that whole process shows you how analysis works. You go from what happened, the margin dropped, to why did it happen, costs went up to where do I look next.
You go read the footnotes, read what management has to say in the annual report.
Okay.
So let's put it all together now. Let's take all 6 ratios, the common size analysis, the benchmarking, and build a complete story of corporate strategy using DuPont versus Dow Chemical in 2012. This is where the numbers really become a narrative.
Let's do it. We can start with risk, with leverage. DuPont's debt ratio was high, 79.5%. Dow's was lower, at 68.6%.
So right off the bat, DuPont is financed with a lot more debt. It's an aggressive, higher-risk strategy.
Much higher risk. But then you look at profitability at the ROS, DuPont's was 8.0%, which is just, it's incredibly strong compared to Dow's 1.9%.
So for every dollar of sales, DuPont is way, way better at turning that into pure profit.
Miles better, which suggests they have better pricing power, maybe better cost control on their specific products.
But the picture gets a little more complicated when we look at efficiency, at asset turnover. Here, DuPont was at 0.71, but Dow was actually more efficient at 0.82.
Right, so Dow generates more sales for every dollar it has invested in assets. DuPont makes more profit on each sale, but Dow runs its factories and its overall operation more efficiently.
So how do we square that? We have these competing factors.
You tie it all together with the ultimate measure, ROE. And despite being less efficient and carrying more risk, DuPont's massive profitability per sale translated into an ROE of 27.6%.
Which just crushed Dow's 5.0% ROE.
Just a vastly superior return for its shareholders.
So the story here, the narrative is, what? DuPont is a high-risk, high-reward company.
That's it. They made a conscious choice. Aggressive leverage, high debt, and a heavy reliance on strong product margins. And that strategy, even with slightly lower efficiency, more than paid off for their investors during that time.
Okay, so that brings us to a really difficult question. We've learned how to diagnose the sickness, persistently low ROE or dangerously high debt. But what happens when the diagnosis is clear year after year and management just refuses to take the medicine? Why would they resist the cure?
And that's where you have to move beyond just the financial numbers and into the world of corporate governance.
Right. The financial analysis tells us what is wrong, but governance explains why the company can't seem to fix it.
If the returns are bad and management is just protecting your own position, well, that's shareholder money just being wasted. It raises the question, what tools do managers use to entrench themselves?
Our sources use that great analogy. The entrenched manager, friend A, is running the company poorly, the stock is tanking. A competent rival, friend B, wants to buy the company and fix it, which would be great for all the shareholders.
But friend A blocks the sale, just to protect his own job.
And that self-interest is protected by some specific corporate defenses, isn't it?
Yes. One of the most famous is the poison pill. It's a financial defense mechanism designed to make the company so expensive and unattractive that nobody would want to acquire it.
So it prevents shareholders from selling to a better management team.
It does. And the other key tool is the classified board, or a staggered board. This is where directors only come up for re-election every few years, not all at once.
Which means shareholders can't quickly replace an underperforming board or the CEO that board is protecting. Change becomes glacial.
And that connection is so important. Financial analysis is the diagnosis. It tells us the ROE is 8% when it should be 20%. Corporate governance explains the prognosis. It tells us whether the company even has the ability to heal itself.
So we've covered the 6 key ratios, we've looked through the efficiency and structural lenses of common size analysis, and we built that whole high-risk, high-reward story of DuPont versus Dow. You really are equipped now to move beyond the spreadsheets.
And as you move on to analyze your next company, we want to leave you with one final provocative thought.
Traditional ratio analysis, everything we've talked about, it relies so heavily on the income statement and the balance sheet. But it often overlooks one absolutely critical document.
The statement of cash flows.
The CAS.
A company can have pristine profitability ratios, a fantastic ROS, a great ROE, beautiful reported earnings. But if it isn't actually managing its cash, if it's not collecting from customers or it's building up huge piles of inventory it can't sell, those pretty ratios won't save it.
Because a cash crisis can be fatal.
It can be fatal, even when the books look perfect. So always check the cash flow.